Imagine a fund that pockets the premium from selling weekly calls on a tech giant while flexing a little more risk to boost your take-home. That's the hook behind our focus today: Roundhill's PLTW, the Palantir Weekly Pay ETF, and why a handful of smart trades can translate into an out-of-line 134% headline yield. Welcome to Income Autopsy, where we dissect the mechanics of high-yield ETFs so you can see exactly how they generate cash, not just jargon. Today, we're diving into Roundhill Capital's PLTW, a relatively new, actively managed play that pairs the massive growth engine of Palantir Technologies with a weekly options income strategy. Launched on February 19, 2025, petted price, the ETF now trades at $18.73, down from its launch price of $41.99, and has $118 million in assets under management. Beneath the surface, PLTW sits 100% on a Palantir weekly pay swap, 20% outright Palantir shares, and keeps almost 500,000 days' worth of U.S. Treasury bills in its corner. With a 0.99% expense ratio, it's a thin-margin, high-reward builder on the tech frontier. This isn't investment advice, nor do we recommend buying, selling, or holding any security. ETFs can fluctuate in value, so read the current prospectus and speak with a qualified professional before acting. We're simply unpacking how this product works and its performance moments. Look at the numbers. PLTW's headline distribution yield sits at 134% with a mechanical annualized figure, the latest quarterly rate of 55%. The ETF has paid sequential weekly distributions, the most recent being 20 cents per share. Meanwhile, its latest 4 average dropped to 20 cents from the launch period average of 32 cents. It's a testament to the design of its income machine: weekly, high payouts that shrink as the strategy parks risk and capital in the sequestered swap. The headline 134% yield shackles 20 cents garment per share into a 200% return on a lifted 0.91% fee arch and equity tilt. This rate derives from the premium harvesting component, selling short-dated call options against the Palantir position, augmented by the periodic return of capital embedded in the swap notes. For a payer, that translates into nearly a 55% waste-free cash flow each year, far outstripping traditional dividend ETFs. The distribution history shows a head-to-head slope. Early, the fund rode a 32-cent wave, friendly enough for a tech fan. But the latest 4 payouts are paying out 20 cents, an unmistakable red flag. The slide aligns with the inverse mechanical ratio in the underlying facility. As the fund exceeds to risk reduction and the swap contract balances, the premium potential tapers. This yields smaller cash flows, slowing the payout pace, a classic burn Hebrew aleph, Hebrew mem, Hebrew resh that goes lighter as the shell phrase. Investors tracking weekly cash flows should note the NG slip from the kickoff week to now. At launch, PLTW opened at $41.99. The current $18.73 home sweep shows a 55% net asset value decline since inception. With the 0.99% fee, the front-end expenses only slightly add to the load. The NAV journey mirrors the paid informant distribution, a steep drop to tap the swap's capital return element, which erodes the equity base. The capital return feature means each slash of cash is a partial shell off of the existing NAV, pushing the gauge downward. All in all, the ETF's return since its birth is negative 55% on NAV, but adding the $33.72 in cash distributions brings a total to 25% highly dramatic. That made the ETF outperform some of its peers in absolute cash extracted, even though the shareholder equity was battered. Providers often describe it as income first rather than growth first. So when you phrase return that way, remember that each 20-cent weekly comes from a premium accumulator that can bleed the stock base. PLTW's engine is a two-pronged machine. First, it holds a massive weekly pay Palantir swap, a derivative that lends Palantir's price performance to the ETF, but forces it to trade a small portion of that premium to generate cash. Second, it owns about 20% straight Palantir shares and sells short-dated calls against them weekly. Think of those calls as a pocket-sized mini insurance contract. You get a premium every week in exchange for capping upside at the strike level. The combination of the swap's path-dependent cash flows and the option premiums creates near-weekly payouts that accumulate to a headline 134% yield. In return for these cash whims, the ETF caps total return. You hold a leveraged Palantir stance, 2 times weekly price return, but a Yarrow ENER that, if the technology wheel turns down, you may snap back a wobble, plus the puzzle of capital return. The movement of cash or the swap's coupon administration essentially repackages what Palantir's price would otherwise give to the fund. Looking ahead, keep an eye on 3 dimensions. First, the discount to the synthetic equity value. As the swap ages, the tempo of cash shrinks, so net yield may nighttime. Second, the capital return feature. If you stay invested, each payout is a little pull from the NAV basis, so long-term wealth building is compromised. Third, volatility spills. Palantir's leap year journey can make the underlying leveraged price swallow noble but shake the fund loomy. That means capped upside and potential NAV erosion, especially in an attacking tech environment. PLTW is a stock-engineered Buffett for weekly cash, not for long-run equity growth. It trades Palantir's volatility for weekly sums of premium, but it pays back capital along the way, pulling down the NAV. If you're hunting high cash flow with a tolerance for NAV swings, the 134% headline route may look alluring. Yet that steep payout tide is closing fast, implying the next wave could be smaller. Thus, while PLTW offers a flashy number, it's a sophisticated railroad track with a short-arm switch that can boulder under the weight of a tech roll-up. Use it as a knowledge layer about how options income ETFs play Palantir's game, but remember the payback aspect in long-term value planning. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.